Hello there, everyone. This is Bruce at Fleet Capital Management. It's Friday afternoon, the 25th day of April, 2025. Markets closed, and we're going to take a look, as we always do, at the market conditions because things might be changing. We're also going to take a quick review of some of the protected ETFs that we're in, and also we're going to take a look at some of the new ones that we're in. So we'll go as quickly as we can, but we'll give you kind of an idea of what's going on with the market. We always start by saying that the video presentation is intended for educational purposes only, and the discussion of any security is not a recommendation to purchase or sell the security. As you know, I'm always available to you, Bruce at fleetcapitalmanagement.com. Shoot me an email with any questions. Be happy to answer them. One of our investments has the symbol BALT. Remember, this is a quarterly investment that protects us all the way down 20% each quarter, should we need that. And then each quarter it has an upside cap. Our upside cap is 2.5%. I know it says 2.47, but I bought it at a discount, so ours is just a hair higher than that. And this gray area is how we're protected. So if the ETF closes down, even down 20% at the end of the quarter, we are down zero because this is protected for us. Right now, as of today, the fund is up 0.1%. It just went positive. The return of the S&P for this particular time frame is down 1.52%. We have 66 more days to go before maturity. So what we're hoping for, obviously, is that during that 66 days, the SPY continues its upward trajectory. This light line is the S&P 500. The dark line with the nodules on it is our investment. And you can see the SPY now is just below the investment. We need the SPY to cross up and go up about 5%. And that would give us about a 2.5% net return for just a couple of months. And again, 2.5% doesn't sound like much, but for a quarter, if you annualize that, and we can do that 4 times in a row, that's 10% in an investment that is protecting us on the downside. So that's BALT. We have a NASDAQ 100% protected. So this is a 1 year program. We've got 217 days left. We didn't go into it in the beginning. We went into it while it was still open, but there's 217 days left. We are protected down 100%. We cannot lose. And what we're hoping for is that the NASDAQ will continue over, we've got plenty of time, continue to grow so that we can hit a cap of 8.67. In reality, because of where I bought it, ours is 10%. So these are investments that are not designed for explosive growth. They're designed for protection. And that's what we wanted when we went into these investments. We wanted downside protection. We also want the ability to make a decent return during this very volatile period that we're in. As of today, the NASDAQ, which is called the reference asset, that's the NASDAQ 100, is down about 7.3%. We're down zero. So that's how that one is working. Bitcoin, we have a number of different Bitcoin protected programs that we're in. Many of you are in the one that is 90% protected. I'll cover the 100% next. But this one protects 90% of your investment. You have the potential risk of 10%, and that's it. That you can't lose more than that. And you have a fairly significant upside potential, almost 30%. Right now, since we went into this, Bitcoin's down 3.4%. We're basically flat. We're down 0.08%. Bitcoin was way down for a while earlier in April, and we were down just a smidge. And now Bitcoin is roaring back, and we will get into our bullish area soon. And I think that there's a strong likelihood that we're going to hit our cap on this. Another Bitcoin 100% protected is another asset, but instead of protecting 10%, it protects 100%. This one has 280 days left. You can see how low Bitcoin had gotten, and we really didn't lose anything because we're protected 100%. Bitcoin again is starting to make a comeback. I like what I'm seeing there, and hopefully it'll just continue its movement up, and we will have a nice rate of return. Bottom line is, all four of these investments that I've just covered were purchased and designed to protect us on the downside because of everything that has been happening in the market since the president was elected again and started his little tariff war game, I guess you would call it. So they're doing fine and they're still protecting us. And when we get to the charts in just a minute, I'm going to show you why I believe we continue to need that protection. We always say the single most important thing to know is whether the market is going up or down. Everything follows from there. So let's go over to our matrix. I know we have a few new people watching the YouTube presentations today. Welcome. As I walk through these things, if you have any questions after you view this, just shoot me an email. I'll be happy to explain it to you. But this is a matrix that we use just to look at the overall condition of the market and risk. It's all based on the S&P 500. And these two columns are based on the S&P daily numbers. And in this column, we're looking at volume and momentum. And it can either be red, yellow, which is mixed, or green. Just think of a traffic light. And again, since this is based on daily indicators, this moves faster than the weekly, which we're going to talk about next. And we are seeing some starting of a positive signs. We've been red for so long, we're starting to see some positive signs, and we'll take it. That's great. This was volume and momentum. This side was the daily 3 and 21 moving averages, and I'll show you this on the chart, starting to go up. On the weekly, which is a little bit slower, we're still in a down situation, but it's looking a little bit better. In our moving average stack, based on daily moving averages, a bullish configuration, of course, is when the 20 is over the 50 and the 50 is over the 200. We're not in that. We're still in this negative situation, which is more of a bear market configuration. You can see the scale down here. Hopefully that will change soon. But for now, we have to look at what the market is telling us. It's still in a negative and bear market configuration. This column is our bear market avoidance indicator. It's based on weekly 10 and 20-day exponential moving averages. This is not something that tells us when we're in a bear market. This helps us avoid a bear market. And you can see, based on normal technicals, we went into a bear market on the 17th of April, just a couple of days ago. We started to get our warnings about 6 weeks ago. And we started to make adjustments to all of our portfolios and get much more cautious because of this bear market avoidance indicator that I had created. Over here is the VIX, which is the volatility index. We love to see when it's about 17 or below. If it's 17 to 20, it's caution, and over 20 is means there's a lot of fear in the market and it's dangerous. And we are still, even though we had a pretty good week this week, we're still over 20. We were as high as almost 60 at one time, which was just incredible. But I don't want you to get complacent. We've had a few really good days in the market. We love it, we'll take it. But we are trend followers, and I do not want you to get complacent because the VIX is still over 20. Our bear market avoidance indicator is still down. Our classic bear market moving averages are still down. Our weeklies are still down. It's just we had a positive week. So do not get complacent just because we had one good week. Let's go over to the charts. Here's the S&P 500 on this side, and you can see the 1D in here. This is a daily chart, meaning that each bar represents one day. This is a weekly chart. One bar equals 1 week, which means this bar here is 1 week, and it closed, a little hash mark to the right. is the close, and the little hash mark to the left is the open. So that's this week. Now, let's start on the dailies. Let me show you the positives and the negatives that I'm seeing. First, we'll start with some positives. The very short-term white 3-day moving average has crossed above the 20-day moving average. That's a mild positive. It is. It's a mild positive. It means that we've got momentum recently, as you can see, but it's not as important as like the blue, which is the 20-day crossing above the gold, which is the 50-day. That's a real positive. That's a powerful positive. This is pretty minor. So that's all I'm saying there. This is one of our momentum indicators, and it's hard to see, but it is just crossing the zero line, about to turn blue. That dark color in there is blue. That just means we're seeing some positive momentum. Good sign. Down here, this is one of our volume indicators. This is the on balance volume, which simply means in any day, hour, minute trade, there's both buyers and sellers. And what on balance volume is showing us is who's winning that tug of war, who has more volume in the game, the buyers or the sellers. We always want the buyers to have more money in the game and more trades, and we're starting to see that. But again, these are fast. We've seen it before. We saw it before, then we saw another drop. So yes, these are positive, but we're not out of the woods. The RSI is the yellow line is about to cross the 55 level or the 50 level, and that is a positive sign. But it would be much more positive if that blue line, which is the moving average of the RSI, when that crosses above the line, then that signifies, based on that analysis, that the bear market is basically over. It is curling up. You can see that that slope is starting to curl up. That's also a good sign. Okay, so it's a real mixed bag right now. It's not fully, it's certainly not a bull market. We're still in a bear market, but we are seeing some positive signs. How long they'll last, I don't know. The big deal is that 50-day moving average. I want the price to get above that 50-day moving average, and I want that 20-day, the blue, to get across that 50. That is a very strong indication. We're not there yet. The red line up here is the 200-day moving average. I'm less concerned about that, but in classical analysis, right here, when the 50-day, which is gold, crossed below the 200-day right there, that signified a bear market. So, and that's called a death cross. When the 50-day crosses back up above that 200-day, that's called a golden cross. And that in that piece of analysis, that's what designates the end of the bear market. And again, we're not there yet, but we're working on it. So I'm getting a lot of mixed signals. I'm not seeing anything knock my socks off. On the weekly chart, and weekly, I always say, is more important because it filters out some of the noise of the daily chart. It's a little bit smoother to look through. But I like that this white line, that's our 2-week moving average. The white line is what I call my trading line. I need to see that above that blue line, which is the 10-week moving average. And you can see that we closed today right under that. And what we don't want to happen is try to follow. This one went right up to that blue line and fell down. This one went right up to that blue line and fell down, which means that blue line, which is a 10-week moving average, has acted as resistance. It has acted like a ceiling, and we keep trying to bust through the ceiling to go higher, and it has not allowed us to do that. So, first step is we need to get a close above that ceiling, the 10-week moving average. That would be a very good sign. We're very close, but we've been very close before. It does feel just a little bit different now, but we'll see. We'll have to wait and see. We will rely on what the chart tells us to do. Right now, it's still a level of resistance. I need it to go through. Then the bear market avoidance indicator is the 10-week blue line crossed below the 20-week gold line. Boy, we'd love to see that cross back up too. We're not there yet. We're getting a little bit of positive momentum, but we still have clear down momentum. Our volume indicator is still in the red, but it's getting close to crossing up. We'd love to see that. I'd love to see this yellow RSI line cross the moving average and get above that white 55 line. That would be good. So the bottom line is we're getting close. We had a good week, but we are still in a bear market. Until we're not, until the charts change, we still have to respect what the chart is showing us. And the chart is showing us we are in a downtrend. And we have to respect that. So when you have a really good week, sometimes it's easy to get FOMO, fear of missing out, and that will hurt you many times. Even if I just look at these highs and I put a line here to there, okay? So that was a previous high. This is our most recent high. It's still in a down sloping trend line. And we need to respect that. You have to respect it until it changes. And it has not changed yet. Okay? Let's take a look at a couple other things. Let's look at gold for a second because we have a pretty good position in gold. Gold had just a parabolic run up. A parabolic is an abnormal, almost straight up run, and now it's coming back down a little bit. Am I worried about that? Well, it's easier to look at this weekly chart, and you will see that we have this linear regression. The linear regression looks back over 100 weeks. The red line is the mean. You can think of it like an average. And the blue line is two standard deviations above. The blue line down here is two standard deviations below. What do we know about a linear regression that I have taught you many, many times? Is that when it breaks above the regression, most times it will come back in and towards the mean. I hate to say this time is different, but we're in somewhat of an inflationary environment because tariffs equal inflation. And gold is a great hedge against inflation. So this pullback that we've been seeing, it's not causing me really any angst other than one day. Look at this. On this day, it went all the way down here and then closed almost where it opened. On this day, it closed at the top of its range. Today, it was way down here and it closed up towards the top of the range. What does that mean? That means that every time it drops down, there's buyers coming in to push it back up. So it has come down a little bit. We still have good profits in this. I believe we're up about 14% in a fairly short period of time. But I don't like when it's above. I even said this last week. I don't like when it's above. But in gold's case, because of the tariffs, it may just track above that line for a while. We still have excellent momentum. We still have really good volume. But if we have these short-term pullbacks, I'm okay with that. Now, I won't let it go down forever because I'm not going to give our profit back. And this gold line that I have here, this is an alert to let me know when it touches that line, and then I'll have to make a decision whether to sell it, take our profits. We can always go back into it, or if we're going to let it ride. At this point, I'm feeling good about what I'm seeing on the chart, and I'm going to let it ride. But I promise what I'm not going to do is let our profits go into a loss. That's not going to happen. Let's look at IBIT. So we looked at Bitcoin from the standpoint of the protected ETFs that we're in. And then for those of you who have asked to participate in the regular Bitcoin, which is the symbol IBIT, I've told you for a couple of weeks that I was starting to see some little indications of positivity. And right on this vertical dotted line, that's the day I bought back in. And here's the entry right there. I bought back in, and this thing from the second we bought into it has shot straight up. I think we're up about 8.5% in about 1 week, which is really terrific. A couple of really good things I see on here is that 20-day moving average just crossed the 50-day moving average. Fantastic. Love that. We've got great momentum. We've got great volume. We've got great RSI. Everything's looking good. The only thing I might be a little concerned with, not much, but I don't like parabolic rises. I don't like when things go straight up. I like a more measured return. So what happens in a parabolic rise is you will give back some of it and then you'll start your rise again. That's what normally happens. On the weekly chart, lots of good stuff here too. We have closed that hash mark to the right, and the reason the dotted line is right over is because this is the week that we bought into it. But that hash mark, which is the close of this week, is above the 20-week moving average. Absolutely love that. The 10-week moving average is still below, but it's curling up and in the right direction. We're starting to get some momentum that you can see the green there. The volume is basically kissing. One more week or one more couple of days of positivity, that'll move higher. We're moving above the signal line on the RSI. So again, I like what I'm seeing there. So that's kind of the story. I don't want to take too much of your time before this weekend starts, but the good news is the strategic investments that we're doing during this very difficult time are working for the most part. They're either protecting us on the downside or they're giving us pretty strong gains on the upside. No one makes a lot of money in a bear market. We're doing better than probably 98% of people out there. I'm really pleased with how we're doing. I always want us to be doing better, but what I want to caution is let's not get complacent. Let's not get FOMO. We're still in a bear market. We still have tariffs, which are ridiculous, out on the table. Trump keeps rolling back things because he's getting so much blowback from all over the world and economists and his own party because it was stupid. Tariffs don't work the way he's doing them, and the world is not putting up with it, and they're pushing back. But the reason we had such a good week is because he's rolling back so many of these things because he's getting so much pushback. But there are still tariffs out there. There are still negotiations that need to happen. And I know he says he's the world's greatest negotiator. I would suggest he's the worst, um, based on his track record. But the bottom line is we still have a lot of uncertainty. We still have businesses that are just in shock over having to create new trading partners, moving away from the United States to China, to Japan, to India. There's a lot going on behind the scenes that is not good for America. So we're still in a bear market until we're not. The housing market is not doing well. Mortgage rates are back up, to what I would call fairly significant levels. Maybe they're the old normal, but compared to what we were used to, rates have gone back up. It seems like sales in real estate are slowing. A lot of people are not, we are still spending a lot of money. I just got back last night from Arizona. The airplanes were packed. The airports were packed. Everything was packed. So we're spending money. I think it's a little bit irrational for people to be spending so much right now, but we are a consumer-driven economy. Let them spend if they want to. But companies are pulling back, major corporations, because they don't have clarity on their earnings. So anyway, we're still in the mud. I hope this thing continues to run. I want nothing more in the whole world than to get out of this bear market and go into a full-on bull market. But I just need to caution you that we're not there yet. Okay, I'll end with that. If you have any questions at all whatsoever, shoot me an email. Love emails. Hop on my calendar. More than happy. And just to remind anyone who has forgotten, front page of our website, which is fleetcapitalmanagement.com. Two buttons. This button will take you to the most recent market analysis video, but this button will show you my calendar and you can select a time that is convenient for you and we will automatically be scheduled for a Zoom meeting so we can talk about your account and maybe your concerns and just anything that you want to talk about, I'm available to talk about. Okay? Have a wonderful weekend. I'm always here. Shoot me an email. Talk to you soon and we'll get back at this Monday morning. Bye bye.